So economic growth and inflation are very much diverging right now. That the economy is slowing, inflation is sticky and persistent. You look at what's going on with GDP growth, just as an example. In the third quarter of last year, GDP growth was 4.9%. Then in the fourth quarter, it was 3.4%. Then in the first quarter of this year, it's 1.3%. So we're sort of going in the wrong direction. Yet you look at a number of the key inflation metrics. Wholesale inflation, the producer price index, is actually up over the last 6 months. The consumer price index, retail inflation, is up over the last couple of months. The core personal consumption expenditure index, the Fed's preferred measure of inflation, has been very, very sticky over the last 6 months. What's happening is the procedural base effects are rolling off. The good inflation or low inflation that brought the overall inflation data down over the last 18 months is sort of rolling off, being replaced with higher inflation metrics. And you know that in your own life. You know, gasoline is up, electricity's up, food's up, housing's up, wages are up. And so you look at the overall economy and you've got sort of a tale of two directions here. The economy's slowing, inflation's sticky, and to some degree that's, sort of a problem for the Fed. So the parlor game that's most interesting right now is what's the Federal Reserve going to do as a result of what's going on in the economy from an economic growth standpoint and inflation standpoint. Now, the consensus view in our view has been just way too optimistic. At the very beginning of this year, the market was assuming that there would be immaculate disinflation and an immaculate pivot, which meant that the inflation was going to come straight down, waterfall decline, and the Fed was going to turn around and start cutting interest rates 7 times this year, with the first cut coming in March. In our view, they were smoking dope. We were never going to get a situation like that. Inflation, sticky and persistent. The Fed, in our view, is maybe going to cut interest rates 3 times in the back half of the year. In light of economic developments in the first, 5 months of this year, we have altered that view. We now think the Fed is going to cut interest rates maybe once or twice after the election. And there were 2 FOMC meetings after the election, November 7th and December 18th. The market has sort of pared themselves back. They're thinking maybe 3 cuts now. So the market remains out of step. And our view is that, inflation is still sticky and persistent, and the Fed is going to give us less rate cuts than the market is generally perceiving. So the positioning of client portfolios, given a number of these economic and policy cross currents, is challenging right now. Our view going into the year was that we would experience a barbell-shaped year in the equity market. We thought we'd get out of the gate in good shape, and in fact we have. The market's done better than we thought. The market's up 12% since the beginning of the year, up 30% since the bottom of the market last October. We were thinking that, we'd sort of have a mid-single-digit increase. So the market, in our view, is ahead of itself. The middle of the year, we're expecting a consolidation in stocks for a couple of reasons. Early in the summer, basically now, we felt that there would be some concern and confusion over inflation data and Fed policy. That would relate or result in a correction in stocks during the second quarter. As we get into the third quarter, investors, we think, are going to start to focus on the confusion relating to the election. And historically, the market in the August, September, October timeframe tends to reflect what they think is going on with the election. Now, President Biden right now is running a weighted average approval rating of about 36, 37%. That's not very good as these things go, which would suggest that the stock market might correct during the late summer, early fall months as well. And then once we get past the election, the market historically enjoys a very powerful post-election rally that we think in this case will take us up to new record highs. So in that environment, we're suggesting that investors play a little defense right now. That the Mag 7 names have clearly driven performance, over the last 18 months or so. We think there will be a reversion to the mean and a broadening out of that rally. So the areas that have been left for dead, domestic large cap value, domestic small cap growth, and international, we think are going to experience some love here in the balance of the year as some of the froth comes out from the Mag 7 names. The election is going to be really close. We know with absolute certainty how 43 of the states are going to vote right now. The entire election is going to come down to 7 swing states. And I think we all know what they are. The 3 key swing states right now are probably the 3 in the Midwest, Pennsylvania, Wisconsin, and Michigan. So how well or how poorly each candidate performs in those states is going to determine who the next president of the United States is. So as it relates to the economy and the financial markets, I'd focus on potential fiscal policy issues in calendar 25 and beyond. Specifically, what do either administration, Biden administration or Trump administration in 25 and beyond, how do they handle the expiration of the Trump tax cuts that were put in place during calendar 2017? Very different approaches based upon what the candidates have talked about. Trump would like to extend and make permanent the cuts in the corporate taxes and individual tax rates. I'm a supply sider, so I'm very much in favor of that. I think that that would be good for the markets and the economy. President Biden has talked about increasing corporate tax rates, increasing individual tax rates. The economy, as we talked about earlier, is decelerating at a pretty rapid rate. I'm concerned that if we are marginally positive at the end of calendar 24 and then institute significant tax increases in 25 and beyond, that could be enough to potentially push the economy over the edge in a recession at some point into the future. So I think we've got very different economic outlooks and financial market outlooks depending upon, which team wins the White House, what the makeup of Congress looks like, and ultimately what happens with fiscal policy based upon taxes.